Hey everybody, I hope you're doing well today. Well, let's take a look at the tools of monetary policy. So within monetary policy, what are the actual things that the bank, the central bank of any government, can do? Well, let's take a look. All right, so tools of monetary policy, what the central bank actually does to manipulate the money supply. All right, key idea. Changing the money supply will changing the money supply will indirectly expand or contract aggregate demand. Remember that. If that doesn't make sense to you, check out the earlier connected videos on monetary policy and aggregate demand. Second key idea. This allows the central bank to target a particular inflation rate, a particular unemployment rate, or a particular rate of economic growth. Okay, so because monetary policy impacts the changing of the money supply, and that will indirectly expand or contract aggregate demand, then central banks can use their monetary policy to target a particular inflation rate, unemployment rate, or economic growth, which makes this a much more effective way of maybe targeting particular areas of the macroeconomic goals, obviously inflation, low unemployment, and economic growth. So what are these three tools? Number one, the Federal Reserve or the central bank of any country can change something called the required reserve rate or required reserve ratio. We should say ratio there, required reserve ratio. That's a typo there. What is that? Well, that is the ratio that each commercial bank is required to keep on reserves, or better say a way of saying that, or a more technical way of saying that, is that the required reserve ratio is the percentage of the total deposits in a commercial bank that they must keep in their vault. Okay? Check out the video on fractional reserve banking to make more sense of that. It's quite interesting how changing the percentage of deposits that a bank must keep in its vault has a direct impact on the amount of money that's flowing around. In very simple terms, if you imagine, like the Federal Reserve Bank right now requires all U.S. banks to keep 10% of all deposits in their vault. So if they receive $100, they can only lend out 90% of that. The other 10% has to stay in a box somewhere. Just think about it in cash, really simply. Okay. Cool. So they take that, my $100, and they can actually resell $90 of that. So $90 went back into the system that really should be in the bank. So it's like new money. Well, think about how if they were to change the required reserve ratio, I got to change this, ratio to 10%, from 10% to 20%, then all of a sudden, my deposit of $100 the bank would have to now keep 20% in its vault, and so only $80 would be able to be re-injected into the system through a loan. And that's a massive difference, okay? So one of the tools of monetary policy, changing the required reserve ratio, or the RRR. Second thing, changing the discount rate. This is the interest rate for commercial banks. So this is what the interest rate the central bank charges commercial banks for short-term loans. So every single day, federal U.S. banks are borrowing money from the Fed, from the Federal Reserve Bank. And the discount rate is the interest rate that commercial banks have to pay to the federal government to borrow money. If the discount rate is increased, then obviously the money supply will decrease and interest rates will rise. Okay, so if the discount rate is increased, that makes it more expensive for Bank of America to borrow money from the federal government, which means that Bank of America is going to charge me more money for my house loan. And if I have to pay more money for my house loan, then you know that I'm going to be less likely to borrow money. The last thing, that tool of monetary policy, is something called open market operations, which sounds super fancy and doesn't really tell you what it means, but I'm going to tell you in a second. That is the buying or selling of government bonds. And the buying and selling of government bonds changes the money supply in a really simple way that I'm going to explain to you right now. Okay. Let's say that the Federal Reserve, right, makes bonds. And those bonds are worth $100. So we'll just say $100, right? Well, there's me, and I'm thinking, hey, I got an extra $100 here that I kind of want to save. And so I'm over here with my $100, and I want to buy a bond. Okay, because bonds are a way of me saving money. Why? Because I can buy a U.S. bond. I have to pay $100 for it. I go to the bond market, which is, of course, this location right here in the middle. I go to the bond market, and I say, hey, does anybody have any U.S. bonds? I want to buy a $100 Treasury bond from the Federal Reserve Bank. And the Federal Reserve Bank sends someone there. This isn't how it really happens. But the Federal Reserve Bank sends someone there, and I go there, and all of a sudden, hey, we have an economic transaction. And the economic transaction means that in the end of the day, right, they take their bond to the market, I take my $100, I end up with the Treasury bond, the $100 Treasury bond here, and my $100 goes into the Federal Reserve Bank. Guess what? The Federal Reserve Bank just sucked $100 out of the flow of money, because that $100 is not in my pocket anymore. It's in the Federal Reserve. It's in the vault. It's not in the economy. It's not circulating around. Why not? Because the Federal Reserve has it locked down in a big vault somewhere. What do I have? You might say, well, I have a $100 savings bond. Yeah, I have a $100 Treasury bond. And what does that mean? It means that at some point in the future, I can go back to the bond market and sell this back to the Federal Reserve. And they'll give me my $100 back plus interest, so like $110. So I made $10. That's why I did it in the first place. But what the Federal Reserve was doing was wanting to get my $100 out of the marketplace and keep it in its vault. And that way, they just contracted the money supply. So by going out onto the open market, that means going to the bond market, say, whatever, New York City, and selling its bonds, what the U.S. government is doing is actually sucking cash out of the economy and putting it in its own vaults. And that money is considered out of the game. Well, you might say, well, what about my $100 Treasury bond? Well, this $100 Treasury bond, can I go to the grocery store and buy something? No. Can I go and deposit it in a bank? I mean, I probably could. They'd probably buy it for me, but not really. Is this effectively cash? No. I can't go buy a pizza. No, in order to buy the pizza, I'd have to go back to the bond market and try to sell it in order to get the $100 out to buy pizza. No, that money is effectively out of the system. And that is what open market operations is. It's the buying or selling of government bonds by the government. So you can see how the opposite would be true. So contractionary monetary policy would be the federal government making up these little pieces of paper saying, this is worth $100, going to the bond market. I go to the bond market and I buy it for $100, and I go home with a bond, and they take $100 out of rotation. Now they have $100 over here, and let's say that they feel like there's a recession, and things are slowing down, and they want people to expand the money supply. Well, then the Federal Reserve would just turn around, take my $100, go back to the bond market, and find someone else to buy it. And what would they get in exchange? A $100 Treasury bond for $100. And then that bond would come back to the Federal Reserve, and all of a sudden, there's an increase in the money supply again, back out to where there's $100 available for pizza, beer, whatever, okay? So open market operations is a really cool way in which the government uses the private markets to control the money supply, and all they do is print up pieces of paper that are worth $100, Treasury bond. They offer an interest rate. They go to the open market. They sell it. And by doing that, they can actually contract the money supply. And of course, if they want to expand the money supply, what they do is they go out there, right, and they take $100 that they have in their vault, and they buy back their bonds. And now they've just injected $100 back into the system. Beautiful. All right. If you have that in your mind, then you have a really clear understanding of open market operations. And all three of these, open market operations, changing the discount rate, changing the required reserve ratio, is a way for the federal banks to change and control the money supply. So I thought I would just throw out one more slide. Jason Welker put together this box. He's very, very good at putting a lot of information in a small area. I can't tell you, go check out his videos online. They are really, really excellent. And this is his stuff right here. So the relative importance of the three tools of monetary policy, and they're in order, right? Open market operations, as I've told you just now, is the buying and selling of government bonds in the financial market. And because it's flexible, in other words, it can be changed daily, and have an immediate impact on the bank's reserves and supply of money in the economy, it is the number one choice, or it is the most available choice, I should say, for the federal bank in the U.S. or in the central bank to control the money supply. The second thing, and this should sort of fall in place for you, is the required reserve, not ration, required reserve ratio. I butchered that word twice. The required reserve ratio, I did it 3 times, is rarely changed. The required reserve ratio in the U.S. has been 0.1 or 10% since 1992. And that means that reserves held at the central bank earn little or no interest, and therefore this required reserve ratio is, if it's raised, banks' profits drop dramatically, since they have to deposit more of their total reserves in the Fed, where they earn no interest. So banks prefer to lend out as much as possible. That is a horribly written box. I should actually start this whole video over and redo that, but I'm not going to. Basically what this means is that the required reserve ratio, and my really simple example that I gave in the last video, is that the banks actually keep that money in their own banks, but they can actually deposit that or require to deposit it in the Federal Reserve itself. And that money's just sitting there out of circulation. So banks would rather have this required reserve ratio be as low as possible, because this is allowing them to resell in the form of a loan 90% of all their deposits. Okay, if that were to go to 20%, then obviously they would lose profits, because they could only sell 80% of all of their deposits. And the last thing is the discount rate. Until recently, the discount rate in the U.S. was rarely adjusted on its own, and instead hovered slightly above the federal funds rate. In 2008, the Fed lowered the discount rate to very low levels as uncertainty among commercial banks brought private lending to a halt. If you know anything about the economic crash of 2008, the market was so volatile that banks wouldn't lend money to other banks because they were afraid that the other bank would go bankrupt. Think about Wells Fargo not lending money to Bank of America because Wells Fargo thinks Bank of America tomorrow might be out of business. And that's a pretty intense thing to imagine, but it was very real. And so what the Fed did was they dropped the discount rate, which is the rate that banks charge each other for loans, down to really, really low levels. All right, my friends, there you have it, the tools of monetary policy. I hope that made some sense. If not, go back and check it out again. It's pretty straightforward stuff once you have it in your head. Congratulations on being an economist. It's super cool. It changes the way you look at the world. All right, thanks a lot, my friends. Hope this was helpful. Talk to you in a bit.